Hello friends, in this video I'm going to explain to you about some of the important highlights of this advanced accounting subject with respect to your intermediate course of the Institute of Chartered Accountants of India. Basically, you would have already studied about some of the important principles of accounting such as double entry bookkeeping and also certain other concepts like dual aspect concept, materiality concept, recognition concept, and so on and so forth. Basically, they provide some kind of guidelines which need to be followed while recording the transactions in the books of accounts and to incorporate them in the financial statements which are prepared by an entity. As far as the subject accounting standards are concerned, they are also basically a kind of accounting principles. However, the term accounting standards represents a kind of mandatory principles which an entity need to follow with regard to the capturing of the transactions as well as presenting them in the financial statement. So now let me just run through the topics which are included in this subject for the intermediate course. There are roughly about 35 individual topics and 11 major topics. All these 35 topics, 35 individual topics fall under the 11 major topics. The first topic is Introduction to Accounting Standards. The second one is Framework for Preparation and Presentation of Financial Statements. Then the topic is with respect to the scope of accounting standards. What are the entities to which kind of accounting standards are applicable? For example, as far as the Indian environment is concerned, there are two important kinds of accounting standards which are applicable with respect to different sets of entities. So that are being discussed in this chapter, namely applicability of accounting standards. The next there are the topic is with respect to presentation and disclosures based accounting standards. Friends, let me tell you one thing. The the kind of uh, segmentation of different topics under specific chapters in the syllabus. Uh, Sometimes you might feel that the meaning is a little confusing. Okay. However, as you read the subject, the clarity you'll be able to get better clarity. Uh, In the meantime, in fact, I have given also a feedback to the Institute of Chartered Accountants of India with respect to the titling of the chapters because, in my view, there are certain conflicting titles with respect to some of the topics or the chapters. Okay, so those kinds of doubts you will get clarified as you keep reading the subject. For example, I'll be mentioning them in the course of running through these topics. Okay, so now coming back to the presentation and disclosures based accounting standards, here they are saying that when you talk about presentation and disclosure, before I take up this, let me just explain to you the basic foundation or the basic principles which go into the uh, accounting standards, the formulation of accounting standards. You know, normally an accounting standard deals with five important kinds of principles, namely recognition, measurement, presentation, disclosure, and derecognition. When you say recognition, it deals about whether to recognize a particular financial transaction or whether to recognize a financial element, and if so, how it has to be measured. Okay, so recognition is the first concept wherein you are deliberating as to whether this particular transaction has to be recognized, and if so, in what manner. Then, if it qualifies for recognition, what are the ways, what are the accepted ways of measuring the monetary resources involved there. Then, the principle of presentation, how to present, or under what classification a particular item has to be presented. Say, for example, inventories, you would have heard about. Inventories refers to raw materials or semi-finished goods or completely manufactured goods. These kinds of items, you know that they are classified under the category of current assets. Okay, so these kinds of principles are discussed uh, under the category of presentation. Okay. So then comes disclosure. Friends, the aspects of recognition, measurement, and presentation, they are all in the context of a financial statement which is prepared and which is being presented for use by the appropriate stakeholders. But as far as the term disclosure is concerned, this refers to provision of additional information which do not form part of the financial, which do not form an integral part of the financial statements, I mean inside the financial statements, but they form part of the financial statements outside of those statements. I mean, below the financial statements, like below the income statement, you might provide some additional information. Below the balance sheet, you might provide some additional information. So, this kind of information are provided to enable a better understanding of the information that is being presented in the financial statements. So, then coming to the fifth aspect, namely derecognition. This is something and the opposite of recognition. So, supposing you have already recognized a particular transaction, when to derecognize them. Okay, either completely of the books or from a particular category. So, for example, when you keep using a non-current asset, say a particular machine, and this machine after a particular point of time, say you don't want to use them, you want to have it disposed of by way of sale. Okay, now this asset, it has lost its original characteristic of being a machine used for production, and now it is classified as available for sale. So now this has to be distinguished separately and presented in the financial statement. Fine. So it is being derecognized as a part of your uh, asset meant for production. Now it is classified, recognized as an asset meant for sale. Fine. Okay. So sometimes you might have recognized an asset, and the asset need to be completely derecognized from the books of accounts because the asset has completely lost its utility. Fine. So this is how you understand the meaning of derecognition as far as the subject is concerned. So now coming back, so there are about 3, 4, 5, 6, 7 subtopics are there under the category of presentation and disclosure based accounting standards. The first one is disclosure of accounting policies. Friends, you might have studied about valuation of inventories under the FIFO, I mean first in, first out, or weighted average method. So now these two methods indicate the kind of choices which are available for a business entity in valuation of the inventories. A business might use either the FIFO method or the weighted average method. Whatever be the methods, it it whatever be the method which is chosen by a business entity, it refers to the choice of an accounting policy by the business entity. So, yeah, when you present your financial statements, you need to disclose in the financial statement as a part of the under the outside of the financial statements, I mean below the financial statements, as an additional information as to how the inventory has been valued. Okay, like this inventory valuation is just an example. There are many kinds of choices which are available in relation to the presentation of transactions in the financial statement. So the important accounting policies which are being followed or which are being chosen by a business entity need to be disclosed. Then the next one is with respect to cash flow statement. Fine. So that is the inflows of cash, outflows of cash, then classification of cash into cash inflows and outflows under operating activities, financing activities, then investing activities. These need to be appropriately uh, presented, and this standard talks about that. Then comes the segment reporting. Suppose a business entity operates in different geographical locations, or it has got a different kinds of customers, or it has got a different kinds of products. Fine. So in that, what happens when you're operating in different products or in different customer segment areas, and then the contribution of each of these segments, whether in terms of a product or in terms of the customers or in terms of the geographical location, the the kind of risks might be different from one to another kind of segment. So if it is warranted for a business entity to present the kind of exposure or the kind of exposure a business entity has got with reference to different products or different locations and how they impact the financial performance of the business. Then the next one is on related party disclosures. You know, sometimes it may not be avoidable that the business entity has got a transactions with the parties who are very much closely related, like the business in a business. One of the directors of a particular business entity may be having another business, and this business entity might be having transactions with the other business entity. So this kind of transactions are called the related party transactions. In case of related party transactions, the business entity need to provide information whether those transactions have taken place in the best interest of the business. So then comes to earnings per share. Earnings per share is like what is the uh, how much the net uh, earnings. I mean, more specifically, in a layman's language, you can say net profit earned by a company in terms of its each unit of share. Okay, then comes discontinuing operations. Supposing a part of the operations of the business are being stopped on account of some business reasons. So those the results of those operations have to be uh, specifically distinctively shown or disclosed. Then comes the interim financial reporting. Friends, you know that normally business entities which are listed in the stock exchanges, they need to file the information in relation to the operations of the business on a quarterly basis, uh, besides reporting on a regular annual basis. So this standard talks about what kind of information need to be provided in an interim financial report. Then comes, as per the syllabus, we have got a major category, namely assets-based accounting standards. So here, the topic has been again um, divided into 7 subtopics. They are like evaluation of inventory, as I already mentioned about the the principle like whether FIFO or average method. So depending on your the choice of method, your valuation also might be changing, at least might be different, at least in the short term. Then comes property, plant, and equipment. An asset, which might be a building or machine or ship or vehicle, uh, or land and building, which is being put into use by the business for its business purpose, those assets are classified under this category, namely property, plant, and equipment. So how to account for them? What are the costs that need to be considered when you are recognizing a particular asset? All those aspects are discussed here. Then accounting for investment. The investments made by a company in external, like investments in like the shares of other companies in external to the entity. Those kinds of principles are discussed here. Then comes the borrowing costs. In borrowing costs, uh, they lay down the principles as to the finance, the costs which are incurred on account of borrowing money, such as the finance administration charges or processing charges, or the interest that are to be paid on the monies that will be borrowed. Those kinds of principles are discussed. Then comes leases, and leases refer to normal nomenclature kind of properties which are rented out. Okay, how to account for a lease? Properties taken by lease. Again, leases could be either an operating lease or finance lease. These kinds of principles are discussed here. Then intangible assets, assets which are not are physically seen and touched, such as the licensing or mining rights. They are all called intangible assets. Or another example which you already come across with is like a goodwill. Okay, how to account for them, under what circumstance they need to be accounted for. Those principles are discussed in this particular accounting standard. Then comes an important topic, namely impairment of assets. You already would have studied with respect to the accounting for depreciation of an asset. Depreciation refers to the normal wear and tear. I know you must be knowing it very well. And as far as impairment is concerned, the it refers to a kind of a sudden uh, kind of reduction in the utility value of a particular asset. Say, for example, we have been using a car. The car unexpectedly meets with an accident, and as a result, the value of the car might go down. So, the principles relating to these kinds of scenarios with respect to assets are being discussed. You need to understand that the concept of impairment does not restrict itself only to non-current assets such as building, machinery, or vehicle. It is also applicable to current assets as well, like a trade receivable, or which is also known as sundry debtors. Then comes the category of liabilities-based accounting standards, wherein the subtopics are like employee benefits. When you say employee benefits, they basically refer to the benefits uh, which will be accruing to an employee on account of his service, but which the employee will be receiving in future period of time. Say for example, an employee who works for in a company for 5 years of time might be entitled to some retirement benefits, or if he completes a particular number of years of service. So for example, in India, an employee with a very recognized entity works for 5 years, he is entitled to something known as a gratuity. He might also be entitled to something known as um, leave travel concession. These are all like future benefits. So this standard provides for the principles with respect to accounting for those kinds of benefits which an employee would be receiving in future. Then comes the standard relating to provisions, contingent liabilities, and contingent assets. You know, there are cases like wherein some of the business entities have not recorded for their contingent liabilities. Okay, and these principles, in fact, applies to situations wherein we need to provide for, like, outstanding expenses or a kind of liability which might or might not arise, as well as in relation to contingent assets, which are similar to like an asset which might arise or might not arise depending on a particular event. Then coming to this category of accounting standards based on items impacting financial statements. Here again, actually, you need to understand that every standard or every financial item has got an impact on the financial statements. It is not only this particular category uh, kind of items which impact financial statements. So this is just for the purpose of uh, no, for the purpose of simpler, for the purpose of classification of uh, the total subject into different topics. This particular nomenclature has been used. So you should not think that other standards are not having any impact on the financial statement of the business of a business. Okay. Now coming to this classification, the standards which are included are accounting standard relating to contingencies and events occurring after the balance sheet date. You know, a balance sheet is prepared as of a particular date. Okay. Now, what happens if uh, a particular event happens after the balance sheet date? Whether it has to be recognized in the balance sheet, which the date actually has already the date actually is something of historical, but the event is happening after the balance sheet date. So the principles, those kinds of principles, the principles which relate to these kinds of contingencies and events are being discussed in this topic. Then the next standard talks about how to account for certain prior period transactions which are not recorded earlier. Okay. So, and also, like, if a business entity changes its accounting policy from one method to another method, or from one choice to another choice, how to how to represent them in the financial statements, those kinds of principles are being discussed. And the next one talks about the foreign exchange rates, the changes in foreign exchange rates. You know, when businesses which have got uh, transactions in other currencies like import or export, or purchasing of capital assets, things like that. So those kinds of transactions necessarily involve buying or selling of foreign currencies, and naturally, due to the fluctuations in the foreign currencies, the there could be gains or losses on account of the transactions. So how to account for them? Those kinds of principles are being discussed here. Then comes the topic, namely accounting for taxes on income. Basically, two kinds of taxes. One is current tax, and the other one is deferred tax. So, deferred tax is something which arises on account of the difference in the principles which are enshrined in a financial reporting regulation versus the regulation in the taxation rules. Certain expenses are recognized in the financial statements as and when it occurs, but as far as the tax regulations are concerned, certain expenses are allowed for deduction against the income by the tax authorities only on fulfillment of certain conditions. Since there are differences in with reference to time, which are known as timing differences, there is a uh, concept of tax is known as deferred tax, which could be an asset or which could be a liability or it could be an income or an expense. So this standard deals with those kinds of financial items. Then comes the standards relating to construction contracts, wherein the revenue occurs over a period of time. How to account for the revenue on an annual basis. These kinds of principles are discussed in the standard relating to construction contract, uh, which is also like a revenue recognition, wherein this standard provides for principles as to when a business entity actually becomes eligible to recognize the revenue in its financial statements. Sometimes it might seem that you are eligible to for the revenue, but actually, if you study deep into the terms of uh, business with with a customer, you might not really be eligible to claim the revenue. So one needs to study this standard in detail to be very clear as to the timing of recognition of the revenues of a business entity. Then the standard relates to accounting for government grants. Suppose an entity gets the grants from the governments, then how to account for the grants, particularly when it comes in relation to a long-term assets. Say, you might be in order to promote like electric vehicles, the government might give a business some kind of grants. So those kinds of grants, how to account for them. So the principles in relation to such kind of grants are being discussed in an accounting standard for government grants. Then comes amalgamations. Business entities, kind of take quite often they go in for mergers and acquisitions, so which are all like in the form of amalgamations. So this standard provides for st- clear principles in relation to the combination in relation to combination of the financial statements in relation to the combinations as well as the combination of assets as well as liabilities. So those kinds of principles are discussed here. Then comes consolidated financial statement. When a business has got more than one unit under its group, so uh, and particularly when they are in the form of parent as well as subsidiary units, you need to prepare a consolidated financial statement, and this standard deals with those kinds of principles. And then the next one standard is how to account for investment. So when a parent company has got investments in the subsidiary company, okay, or its associate companies, how to account for the kind of investments and how to present them in the financial statements. You need some certain kind of guidelines, and those guidelines are laid down in this particular standard. Similarly, the next standard is in relation to the joint ventures. Yeah. Business entities which are all quite different, they might have a kind of joint ventures. This normally happens, say, for example, in the case of offshore oil drill and all. Okay, so two different companies which are altogether completely different might go in for a kind of joint venture, and they might spend on account of assets, on account of expenses jointly. And this standard talks about the principles which need to be applied in relation to such kind of transactions. And then comes the chapter, namely on preparation of financial statements of companies. Yeah, so far, we have just discussing about the standards, and now based on these standards, how the financial statements are being prepared. So this is the this topic deals in depth about the preparation of income statement, balance sheet, as well as the cash flow statement and additional information. And also, there are certain few other topics, so the topics which relate to the how to account for securities which are being bought back by a company from the investors, and then how to account for how to present the financial statements in relation to amalgamation. Then also when reconstruction takes place, how to account for them, and also a chapter on accounting for branches, um, including the foreign branches by a business entity. I will quite often be uh, updating you with similar kinds of videos and also with the guidelines in relation to each of the topics. So keep tuned uh, in this YouTube channel. All the very best for you. Thank you.